Welcome to chapter 21, Charlie Munger's third rule: a stock must be stable and understandable. In this lesson, we have two objectives. The first objective is to understand why stability is important for determining an intrinsic value. The second objective is why it is important to invest in a company that you understand. So let's get started. We have made it to the third rule: a stock must be stable and understandable. All four of these rules must be met. So let's go ahead and learn a little bit more about this particular rule. So we have a person named John, and we have been tracking John's equity, earnings, and the debt for the last 10 years from 2013 to 2023. And what we are going to do is just going to assess John's in each one of those areas: the equity, the earnings, and his debt that he has managed over the last 10 years for himself. This is not a company. Please remember, this is just John. Okay. So when we look at John's equity over the last 10 years, we see that it had its ups and its downs, and generally it's moved up in the direction. When we look at his earnings, which you can see the chart that the numbers on the left, and then you can see it is graphically represented on the right. Those are his earnings. You can see that they have generally grown, but they have kind of had their ups and downs as well. And recently, in the last 5 years, it's been kind of steady and level. Then, when we look at his debt's kind of all over the place. It's been high, it's been low, and it's generally kind of stayed at the same level, which is kind of high when compared to his equity he had. So, the point that I'm getting out with this is, if you are going to predict how much equity John would have in the year 2024, it might be a little bit hard for us to determine that based off of his past performance. Now, that doesn't mean that in the future he could just start having very sustained equity growth. He could have very sustained earnings, very consistent every year, pretty much the same that could happen. But most likely that won't happen. This type of person will continue to live his lifestyle, and he's going to have those ups and downs, most likely in the future, which makes predicting how much he's going to be worth, because that's really what this is: his equities, his net worth, if he would liquidate or if he would die. John's assets would be added up, and then subtracting out his liabilities, that would be his equity. But predicting how much equity he would be in have in 10 years from now might be a little bit very difficult based off of his previous lifestyle, in the way that he lived his life. So let's look at a different person. Let's assume that we are going to look at a woman named Varshi. Now, Varshi lives a completely different lifestyle than John. We are looking at her equity, earnings, and debt. And when you look at her equity, you can see that her equity grows very steadily every single year, almost by the same margin. It's very linear graph when we look at that equity graph. So when we look at Varshi, let's say we wanted to estimate how much equity she would be worth in 10 years from now. I think everyone can agree that that would be very lot easier to estimate where Varshi would be when compared to John. So, as we look at these two people, the thing that I want you to take away from this scenario is that the businesses are managed just like these individual people. The businesses that we want to find, that we want to invest in, is that business that is very steady? Is that very predictable? Because when we were trying to figure out the intrinsic value of a business, we are going to be adding up all the cash that we could take out of the business over 10-year period. And when we are making that assessment, it's very difficult to do when you have a business that moves like John as opposed to a business that moves like Varshid. So just because a business has a volatile numbers doesn't mean it won't make a lot of money in the future. That's not my point of pointing this out to you. John could be worth 10 times as much as Varshi in the future, but the reason I show this is because John is unpredictable. You can't really predict where he's going to be. Whereas Varshi, you have a much better idea of where she is going to be. And so that difficulty to predict that value of where something is going to be in the future, that is risk. And what we are trying to do is minimize our risk while still having some decent returns. So what I'm going to do now is I'm going to show you some real companies not these scenarios with individual people that I described just now. I'm going to show you real companies like Neo. Neo is a Chinese car manufacturing company, and then Bank of America. The ticker symbol is BAC. And what we're going to do is we are going to look at their equity, and we are going to look at their debt to equity, and we are going to look at their earnings and see how it is progressed over the last 5 to 7 years or more. And then what we're going to do is compare the two. I'm going to go to the tradingview.com, www.tradingview.com. I have a subscription here. And then I'm going to first pull up the ticker symbol NIO, NEO. Uh, okay, so here we are at the top of the page. I'm going to enter NIO ticker symbol and I will enter, and it takes us to the top level page where it gives all of our information related to the NEO car company. We were able to go back and look at past few years trends, probably around 5 to 7 years. So to do that, you have to click here on the financials, and from there click on the statements, then from there to balance sheet, change the view to annual or quarterly, but right now I'm going to change it to annual. Come down to book value per share. Here you see here. Look at the book value per share and how it's changed for Neo over the last 5 to 7 years. You will see it says book value per share here. And if you go back to my previous class, day 4, what is a share videos, if you're not familiar with that, you'll probably have to go back to the day 4 video where we learned about the book value and all that information and equity per share. So we're really looking at the equity of the business and how it's changing over a 5 to 7 year period. So when we look at Neo back in 2016, it is worth negative actually, which is not good. Negative 54 cents a share. And then the next year it is 2017, it's still negative, went down more to negative $1.70. And then in 2018 it is looks positive, which is 95 cents a share. This is somewhat similar to Mr. John's equity that we saw earlier. I would definitely avoid these type of companies looking at these numbers, as I cannot predict their pattern or behavior. The next number is the debt to equity ratio. You can find this number under Financials tab and then click on Statistics, change to Annual View, Data View, and come all the way down here. If you remember from Charlie Munger's first role, where we were talking about the debt to equity ratio, Charlie Munger likes a business that has a debt to equity below 0.5. This is a number, this is really a great number to look at. You can see the trend and how the company has been managing their debt over the last 7 years. When you look at Neo, they have these numbers all over the place, not consistent. Now, as far as the earnings per share, if you remember from my day 4 what is a share video, this is a very important number because that's essentially your profit per share. So in order to find that, click on the earnings tab under financials here and change to annual data view. So definitely I would be very cautious and I will try to avoid personally before even thinking about buying this company. Now I'm going to show you these numbers that we captured plotted on a graph. Now when we look at the equity plot, you can see that on the chart that's not a good trend. Whenever you are looking at the equity, you want it to be consistent, going in a positive direction, not in a negative direction. And not only do you want it to be going in a positive direction, but you want the chart to be really linear, because the more linear that it is, the more predictable it is for you to assess how much that equity is going to grow over the next 5 to 10 years. Now, when we look at the debt to equity for Neo, in 2016 it is 0.05. In 2017, it's 0.09, which is good. 2018, 0.47. It gradually went up to 2.05 in 2030. That's something that you want to pay attention. So when you're trying to predict the intrinsic value of this company, debt seems to be under control, but that is not the only single factor. You need to look at the earnings and other factors as well. So you need to be very careful before making a judgment. Now let's look at the earnings for Neo. It's all negative, 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 and all over the place. It's hard enough to predict what they are going to do in the next year, let alone 10 years. So if I was going to be trying to calculate the intrinsic value of Neo based on this chart and numbers, I would have absolutely stopped right here. I would have never even gone to the calculator to find out intrinsic value, which you will be learning in our next chapter. This would have been the end of the road for me with this talk. Now let's go ahead and take a look at these numbers for Bank of America. I'm going to go to www.tradingview.com and let's pull up the Bank of America ticker symbol BAC numbers. Just type in BAC ticker symbol here, hit enter. It will be at the top of the uh, Bank of America information page. Just like we did before, come over here to the financials tab, then click on balance sheets, and then statements tab, change the annual data view. Now when we look at the book value, which is just the equity per share, you can see that in 2017 the equity was $23.08, goes up all the way to $33.34 in 2023. You see a nice steady trend. That's exactly what you are looking for whenever you are trying to find a good business. When we look at the debt to equity ratio, we can see that the Bank of America has generally managed their debt below 2.12. But actually we want this number to be less than 0.5 as per the Charlie Munger's rule number 1. Now let's go over to the look at the earnings. By clicking the earnings tab here, you see this is generally trending in a better way and started off at $1.50 in 2016, and now it's up to $3.08. And you can see that it is trending up and it keeps increasing, and that's exactly what you want to see with your earnings. You always want to see your earnings increasing like that if possible. But at a minimum, if the earnings are consistent, let's say it was $3 for all these 7 to 10 years, that's wonderful. When you see it is growing, it's even better. So let's go ahead and chart these numbers on a graph. We can graphically see what those numbers are doing. So on the left we have this equity for Bank of America, and you can see that it's a nice linear graph over the last 8 years, and you can see how they are growing that equity. When you have a company that's growing their equity nice and consistent like this, you are going to see that's reflected in the market price, and the market price is generally going to trend exactly with the equity. Now the debt, you can see that is above 0.5, which is not great. Now if you look at the earnings all to the right on this graph, it looks great and trending in a linear fashion. So if you are looking at a company that's stable, now I'm not saying that this is a stable company that you should buy, because we still have to figure out what it's worth. But if you are trying to predict these companies' future, it's going to be in 10 years, it will be easier. I think we all can agree that this is going to be so much easier to predict than a company like Neo. Now, in 10 years from now, Neo might be the best company on the universe and Bank of America might be the worst. But what we are trying to do is we are trying to be able to predict which company is going to be where in 10 years from now, based off of these charts. In this rule, we not only want to have a stable business and a predictable business, but we want to also have a business that we understand. You generally want to stay away from the company that you really don't understand, because you're not going to really understand the ins and outs of the direction that the company is moving. Now, as far as the Bank of America, I think it's going to be a product that's I am going to be using and will be there around for years to come. So I can somewhat understand Bank of America. So if the numbers would check out, and let's say the Bank of America would be a good buy, then this would be a company that I would be comfortable buying. This part of the rule is something that a lot of people might not follow, and I would strongly discourage you from that, because it's I think it's really important to understand the business that you actually own. So this concludes our third rule. A stock must be stable and understandable. And hopefully those tools that I showed you will come in handy. Make sure you go back there and try with a couple of different companies. You can look at how that equity is grown, which is the book value. You can also look at the earnings per share and see how that's trending. And you can also go back and look at the debt to equity and apply those rules that we learned in Charlie Munger's first rule, which is a stock must be managed by vigilant leaders. So the next chapter we are going to talk about how a stock must be undervalued, and we are going to be finally figuring out the intrinsic value of a business using calculators available freely on the internet. So this concludes chapter 21, Charlie Munger's third rule, that a stock must be stable and understandable. We learned why a stability is more important for determining an intrinsic value, and we learned why it was important to invest in a company that you understand. So I really look forward to seeing you in the next chapter, where we will be figuring out intrinsic value of a company in real time like great investors.